NVIDIA results sparked a monster rally in big tech last year, and that has investors bracing for yet another critical report next week. Take a listen.
I do think the sky's the limit. This is the third time in my career, I'm now 45, where I think I've seen something that is going to have a before and after epochal change. So internet, CRISPR, and now AI. I think that the AI movement will have at least as big an economic GDP impact as the internet has, maybe greater. And so does that translate into an ever-growing stock price? That I can't say.
The sky's the limit. The hype is ever real. Let's continue the conversation now with Telbaken's Michael Purvis. Michael, here we are in the world. It's all calm in the VIX. We've been under 20% for about 4 months. And then I look at the options buildup in NVIDIA with implied volatility on their earnings around 11%. Do I need to be thinking about Wednesdays, not just NVIDIA earnings, but also a day of a potential volatility event?
Well, it's interesting you bring that up because there's even a bump in the SPX volatility for the, in other words, a premium for SPX options on the NVIDIA announcement. And I think it's a little bit of a metaphor for how important NVIDIA's earnings are for this overall trajectory of this stock market right now. One of the things I've certainly been very focused on is the how low correlation across stocks have been. And one way to think about that is just there's not a lot of macro priced into single stock options right now, which is arguably a sign of too much optimism, I think, at sort of creeping in. Ironically, it may be a single stock earnings release next week that if they do disappoint, or at least don't exceed expectations, that might be the actual kind of sort of quasi macro event that actually drives correlations across stocks higher. It's a very unusual condition but let's face it, NVIDIA was the anchor of the big tech rally last year, and big tech was the anchor of the broader stock market rally, and that continues to be the case this year. Valuations have been stretched. They've done a masterful job of producing earnings growth last year there, but if they, at this stage, I think if they do underperform, it will be a volatility event, for the broader market.
Well, on that note, Michael, I was reading your note from earlier this week, and this stood out to me when you wrote that a variety of volatility metrics are eerily similar to January 2018, just before the manic VIX surge a couple of weeks later. We are not saying this will be happening this week or next week, but we are saying there is plenty of gunpowder and plenty of matches lying around close by. If you want to lose some sleep tonight, that's a good note for all of our viewers to read, Michael. I mean, could this be it? Could bad NVIDIA earnings be the match lit?
That's one of the potential catalysts. It could be more economic data that affirms that we're not going to get rate cuts anytime soon. Could be a geopolitical event. You just never really know. But what you do know on the sort of the gunpowder side, if you will, to torture this metaphor, is that there's been various facets of short volatility trades that have been working, that have been put on in sort of, it feels like an increasing scale there into a stock market that has, done extraordinarily well. And so if you think back to the Volmageddon of February of 2018, that was when the XIV ETF, sort of a short VIX ETF, famously, just blew up and, yanked the VIX up from very low numbers to I think as high as 50. And of course that rippled through to equities and gave everyone a little bit of agita, regardless of what you were investing in at the time there. And I think there's a lot of similarities between now. Like, if you look back at 2017, you had a strong rally, you had a lot of divergence led by tech in that year, same thing like last year, and so forth. If you look at implied correlations now, they're basically where they were back then there. And too much of a short volatility trade just at some point engenders a big volatility spike there. It doesn't mean that and it really doesn't have to be bad, anything bad fundamentally in the economy or anything like that. It could just be something that gets the market to say, wait a second, we're not going to keep buying this dip, realize volatility picks up, and then that triggers a bunch of closing out of short volatility trades, that process is inherently a convex process.
Right. Well, Michael,
so
because I remember when that 2018 Volmageddon VIX blow-up happened, and at the time I'd spoke to a tiny little fund in Colorado that was going long volatility because they thought that would happen. They got something like an 8,600% profit, I think, on it. If you're saying the market structure is set up that way, should I be punting on that type of options trade, getting ready for an explosion in volatility?
Yeah, well, I think you've seen VIX call buying tick up over the last few weeks there, and I think that's certainly a trade I've been recommending to my clients earlier this year. I think if you look at the VIX, it's sort of cautiously making a series of higher lows and higher highs. They're nothing dramatic yet, but it feels like things are building here. And, it's funny, you look at basically economic conditions are good, earnings are reasonably good here. But let's face it, valuation has been stretched. I think it's important to remember that the stock market rally last year started with AI. It also started with a massive amounts of offsides positioning.
Right.
And, just for context, more than half of last year's 24% rally came in November and December. And I think a lot of this momentum you've seen carry over into January and February can still be explained a little bit by, some positioning catch-up
but Michael,
there.
I mean, can it be more than positioning? We only have a minute here, so I got to jump in. I mean, earnings have been good. The economic data, okay, hot, but not that bad. I mean, aren't things good enough to just continue the rally?
Absolutely. No, well, yes. Like you can check all the boxes you'd want for in terms of a lot of the fundamentals and the momentum and so forth. And yes, and the rate, I do think rates are going to keep climbing higher here. And I don't think that has to be, the death knell in and of itself. But look, you can go through a lot of great bull trends against good economic and earnings backdrops, and you do see big volatility spikes here. I'm constructive on the broader market this year and on the broader economy, without question. There, but I think after such a sort of tireless rally, a relentless rally, it was such a smothering of correlations across stocks and a lot of evidence that this sort of short volatility trade has been put on. I think we should be bracing for something at some point soon. And again, it doesn't mean that the fundamentals suddenly are broken. It just means that there's too much too fast. And I think VIX calls are probably a better trade than SPY puts in that respect. I just think
another
Volmageddon
would certainly be a way to wake us all up from our slumber. Michael, we're going to have to leave it there. Thanks for joining us. Michael Purvis of Telback & Capital Advisors. Coming up, Republicans talk tough as a government shutdown looms.
You're not going to get another continuing resolution out of our conference in Congress.
We'll get the latest on the budget talks or lack thereof next. This is Bloomberg.
You're not going to get another continuing resolution out of our conference in Congress. The last one was difficult, and that was done because our Speaker recognized that there just wasn't enough physical time to process all the bills once the House and the Senate had agreed on the top line numbers. So this time you're going to have to get these things passed.
Republican Representative Tom Emmer saying the House will not pass another stopgap spending bill by March 1st, the latest deadline for a partial government shutdown. The House is on recess until Feb 28th. And that leaves very little time for negotiations. Bloomberg's Anne-Marie Hordern joins us now. Anne-Marie, does this mean we're going to have to do the whole song and dance again?
Yeah, multiple times we've had to do this song and dance. But let's first say that what we heard from the majority whip there is that he's saying there's going to be no continuing resolution. We've also heard this in the past from Speaker Johnson, and then in the end, we've had continuing resolutions. What makes this so difficult is the timing. So the House has already left, as you mentioned, Danny. They left yesterday, and they're not back till the end of February 28th. And the first deadline for the first tranche of a government shutdown is March 1st, the second then coming March 8th. So there's a wide swath of the government they'd have to be able to fund by March 1st. So that gives them about 3 days to get it done. And that is why everyone is shrugging this off and saying you're going to have to do some sort of continuing resolution, kick the can down the road, or we're going to end up in a government shutdown.
Anne-Marie, we also learned earlier this morning that Alexei Navalny, one of Putin's most outspoken critics who had been jailed since 2021, has died, according to the prison service. Does this change the conversation in D.C. at all?
I think it's a question of whether or not this puts more impetus on Congress to get that foreign aid bill done, because Ukraine is obviously one of the big winners in that aid bill. A number of weapons that would go to the U.S. industrial complex would then be shifted over to Ukraine. And what the White House's response is going to be, they're going to want to punish Putin for this. But already we see the Russian economy have a number of sanctions and penalties against this. We should note what Secretary Blinken had to say about this when he heard the news. He said for more than a decade, the Russian government and Putin personally persecuted, poisoned, and imprisoned Alexei Navalny. His death in a Russian prison and the fixation and fear of one man only underscores the weakness and rot at the heart of the system that Putin has built. Russia is responsible for this. That is the line from the administration.
There's very strong language, and yes, do they back that up with aid passed to Ukraine? Anne-Marie, thank you very much. That is Bloomberg's Anne-Marie Hordern. Okay, let's get you up to speed on some of the sector price action this morning. Let's get over to Bloomberg's Abigail Doolittle. Abby.
Well, we are, Danny, at this point taking a look at a very small decline for the S&P 500, down about 0.3%. Materials, the only sector higher, up 0.7%. So broad participation to the downside, led by real estate, down 1.2%. Communication services down more than 1%. On the week, let's take a look at what is happening for the S&P 500 in terms of the top sectors and the bottom sectors. So two of the best sectors, energy and materials clearly getting a boost today for sure. And then on bottom, you can see that consumer discretionary down 1%. We also have tech down 1.8%. And that is the reason why we're looking at a decline, the first in a little while, Danny, of about 0.2%. So today's trading action is really going to decide whether or not we see a gain or decline for the S&P 500.
Yeah, do we finally see the cracks in big tech after that hot figure? Abby, thanks so much. Abigail Doolittle there. Coming up, the market-moving events that you need to be watching for your Friday trading day. That's next in our trading diary. This is Bloomberg. back from the CPI on Wednesday, but are we going to be able to bounce back from the hot PPI? Look at what tech is doing, down 0.8%. It is the Mag 7 that is getting hurt this morning. Meta down by 2.25%, but of course, Russell 2000. If we're not going to get cuts anytime soon, this thing gets clobbered down by 1 1/3. Bond yields, those are backing up. Rates are moving higher this morning. Front end leading those declines. We're up about 8 basis points, trading just off the highs of the year. All right, time now for your trading diary. Here's what you need to be watching through this day and next week. The UMich Sentiment Survey comes at the top of the hour. Then San Francisco Fed President Mary Daly will speak shortly after noon Eastern. Next Monday, U.S. markets are closed for President's Day. Tuesday, we're going to get earnings from Walmart and Home Depot. Finally, on Wednesday, it's NVIDIA's turn to report. We were just speaking with Michael Purvis, who says that it could be a volatility event for this market if it disappoints, that there's so much option buildup around NVIDIA. If it goes wrong, brace yourselves for a Volmageddon 2.0. In the meantime, we are seeing volatility today. Your VIX is up about to 14.5%, still under 20, so nothing that consequential, but Mag 7 sells off again. That hit to Meta, pretty significant. All right, that does it for us here. That was the countdown to the open. This is Bloomberg.
Great questions.
We're 30 minutes into the U.S. trading day, and here are the top stories we're watching for you in this hour. All eyes on the consumer. We're going to bring you the University of Michigan consumer sentiment data at the top of this hour. And remember, inflation stays hot. Producer prices come in higher than expected, sending yields to the highest levels of the year. And Alexei Navalny, the Russian anti-corruption activist, dies in prison. We're going to speak to a U.S. Senator, Ben Cardin, chairman of the Foreign Relations Committee, who joins us from the Munich Security Conference.
I'm Shonali Bassick, and welcome to Bloomberg Markets. Let's get a quick check on these markets because you have an S&P 500 struggling to hold on to its gains of the week. You have it in the red on the day and in the red on the week so far mildly, but the NASDAQ 100 experiencing even more losses on the week, down about 1% on the day and down more than 1% on the week. The Russell 2000 also feeling some losses on the day, down more than 1.3% on the day, but that is something that you did see significant gains in recent days. We are not wiping out all the gains for the week for the Russell 2000 yet. The two-year yield is where you're seeing a lot of the movement here after that hot inflation data. We do see the two-year yield up about 8 basis points on the day, back to levels that we saw on Tuesday after that surprising inflation data. We are holding at about 465 on the day. Now, data crossing the terminal right now on that UMich consumer sentiment data. Bloomberg's Michael McKee has the details.
We have some good news on the headline, I suppose, because it rises a little bit, not as much as anticipated, but 79.6 from 79. This is February preliminary data. But the number that catches everybody's eye, I'm sure, is the one-year inflation expectations. It rises. Now, this survey largely taken before the CPI and certainly before the PPI came out, and it rises to 3% for the coming year from 2.9%. A minor move, but just kind of fits with the overall general inflation atmosphere. On a 5 to 10 year basis, no change, 2.9%. Now looking at the headline numbers again, sentiment, as I said, 79.6. Current conditions, 81.5. It's a slight tick down from 81.9 last month. And expectations rise, 78.4 from 77.1. That's going to be the one that's more important than current conditions. And it does look like we have not seen much of a change in the way people look at the Michigan numbers from party sentiment. Democrats love it and Republicans do not like it at this point.
When you take all the inflation expectations that are embedded in the report here, the PPI data and the CPI data earlier this week, what do you take from all of this together, Mike?
Well, because it's 1 month's data, you have to say we need more information to know whether this is a change in trend or just, as the members of the Fed said yesterday, kind of a bump in the road. The PPI data, interestingly enough, affected significantly by portfolio management, which was up 5.5%. That will feed into the Fed's favorite indicator, the PCE index. So the market almost working against itself. People in the markets are pushing stocks up because they think the Fed's going to cut rates, but because they're pushing stocks up and making more money and the price goes up, the Fed may not move.
Bloomberg's Michael McKee, we thank you for your analysis. And Mike will be speaking live with Joanne Su, the University of Michigan Survey's Consumers Director, right now for some instant analysis. You can find that on Live Go on your terminal. And for more on the consumer, we're joined by Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist. Michelle, it's interesting, we've been hearing all week about higher inflation, yes, but also the weakness we've seen from the retail data, divergences we've seen around companies reporting. How do you bring all this data together?
I think the reality is that January is just noisy from a data perspective. It always is, in part because you're coming off of the end of the year when you have holiday sales, which tend to be this big influx of activity, particularly around the consumer, and then weather events and other seasonality issues. So if you look at the data holistically, not just this week for January, on the one hand, you have this extraordinary increase in job creation for January. You have the trending higher consumer sentiment numbers. You have the improving housing data. But then on the other side, you have this stickiness for inflation and the softening that we saw month over month from the census retail sales. So I think if you take a step back and you look at it in terms of the trend, it's still one where it's very clear the economy is continuing to expand.
So where do you look for evidence in the following data that this is not going to be a sticky situation that we're in when it comes to inflation?
Yeah, so inflation, I think, is very, very important, of course, not just when you think about monetary policy, but when you think about where we are in terms of the cycle more broadly. So for inflation, I like to break it down to different categories because the inflation that we've seen in this cycle has not been uniform. And that continues to be the case. So when you look at things like core goods, you are seeing price reductions for a number of categories. Very mixed picture when it comes to food. In the last report, some categories saw an unusual spike up, but generally there's been reductions. And the critical part that I think we'll need to see is a sign that the disinflation in the goods side of the economy is moving into the services side. And there's been a certain amount of what's been called self-inflation, with certain services seeing rising inflation, like motor vehicle insurance, for example. That narrative needs to change. And the question is, can it change by itself, or does it have to change with a weakening in the real economy? And that's still up for debate.
Do you worry that there are some barbell effects here that are happening in the economy, that some people are being left behind in this recovery?
Well, just like inflation isn't uniform by sector, the economy is not uniform, right? We always look at this macro trend in terms of GDP on aggregate or spending on aggregate, and it's really made up of a number of different very important stories. So that's still clearly the case, and it has been this whole cycle, probably more in this COVID cycle than in prior ones, given the nature of this environment. But to me, to answer your question, is around looking at labor market growth. And we have seen continued breadth in job creation. The last jobs report, I think, was indicative of that, with construction jobs rising, manufacturing jobs rising, healthcare and education are obviously those big bright spots. But you are seeing job creation across the board, and that's critical to having a more even recovery.
What do you think the impact will ultimately be? If you see some of the lower income earners here have a harder time keeping up with this inflation, when does it start to ripple through the economy, through earnings and others?
Well, this has been a question for a while, and I think when you actually take a step back and you look at the wage growth across different income cohorts, the lower income population saw some of the fastest wage increases in this cycle relative to prior cycles. So, again, going back to the labor market, I just continue to harp on this because I think it's the most important factor when thinking about the path forward for particularly the consumer. Is job creation is happening across the board, right? You're not seeing evidence like, for example, people working part-time for economic reasons. That's not showing up in the data. There's still churn in the workforce. You're not seeing an increase in unemployment insurance. So all of that suggests that there is purchasing power overall, and that purchasing power should be felt fairly broadly. Obviously, there's individual stories there that we can't speak to. But, as long as you have that job creation, that wage growth across the board, you have to feel good about the ability to spend.
What do you make of the inflation data that we have had? If you have the University of Michigan sentiment data saying that prices will climb at an annual rate of 3%, it's a little higher than it had been before. Do you expect consumers to slow down on the back of those expectations?
So I think expectations have been very well anchored, all things considered. And the Michigan survey that was just released right before this, I think, is consistent with that, right? 1-year inflation expectations will move a lot really based off of prices at the pump. The long run, 5 to 10 year inflation expectations have remained very consistently anchored, even in the face of what was historically very high inflation, a year and a half ago. And I think that speaks to the fact that consumers have, realized that some of these inflationary pops were due to, the environment we were in, and also the overall economy inflated too, right? We had wage inflation, price inflation, asset price inflation. So in the long run, the view is still one for much more modest, slower, manageable inflation. As long as consumers continue to answer it, that's their expectation. I think that's an encouraging sign, particularly for the Federal Reserve as they're thinking about where to set policy for the future.
Michelle, we're watching yields ride higher on the back of a lot of data that we saw this morning. What does it mean for consumers and investors alike to be experiencing such a drastic recalibration of the yield curve here?
Yeah, so, to me, the movement in rates has been more choppiness than something that's going to really impact the average consumer. So for us looking at the screens and the markets, of course, these day-to-day fluctuations matter. But for the consumer, the reality is that we're likely past peak rates, right, in terms of what monetary policy is suggesting around the next move from the Federal Reserve being a cut. And the market has been really smart in pricing that in. So it's still pricing in cuts in the second half of the year. You have seen, some helpful movements in the yield curve over the second half of last year into early this year. So I wouldn't read too much into some of these daily fluctuations. We'll get new data out in the next few days, and that the markets can move off of that as well. So I don't think this is a trend.
Michelle Meyer of MasterCard Economics Institute, we thank you so much for your time.
You got it. Thank you.
Coming up, we'll have the latest market analysis with Catherine Rooney-Vera, Chief Market Strategist of StoneX Financial. Stick with us. This is Bloomberg. Now let's take a look at what's moving markets right now with Bloomberg's Denisa Sekova. Denisa, what's happening over there? Because we see Coinbase shooting higher by more than 10%, shaking off those fears about the ETF impact.
For sure. Coinbase has seen a huge gain, posting profit for the first time in 2 years. That's a 51% increase in revenue. And of course, a big part of this is the digital asset gains we have seen in the last few months of the year. The revenue topped estimates by a large margin. And in the letter, the company cited excitement around the Bitcoin spot ETFs and, of course, expectations about better macro conditions next year and among crypto volatility. Of course, everyone has been watching Coinbase because the spot Bitcoin ETFs are getting some of those retail attention, which is kind of a main part of the revenue the Coinbase gets. It gets a lot more retail revenue than actually institutional investors. But at the same point, Coinbase is also custodian of 8 of the 10 Bitcoin ETFs. So it's actually being lifted by some of those fees. And if those funds grow, this could be a benefit for Coinbase.
Now let's talk about Nike. On the flip side, we're seeing it drop roughly 3.8% on the day. What's going on?
Yeah, so Nike announced a 2% cut of their workforce as the company is pushing those cost-cutting measures. We remember in December, the company announced $2 billion of cost cuts, which is reducing its workforce, simplifying its product lineup. And of course, a big part of this is competition, but also growing consumer caution, which is a story we have seen a lot this earnings season. A lot of companies are talking about cost, and they're talking about consumer pressures building up. So this is yet another sign of that.
Speaking of consumer pressures, we are seeing DoorDash have the worst day since May of 2022. That's even after they beat estimates. What's going on?
Yeah, this is an incredible story because actually DoorDash had a very strong earnings report. It had record number of monthly users, and those users come more often to DoorDash. But of course, the stock has rallied nearly 30% year to date. So the expectations were very high. They're luring a record number of monthly users, but yet their gross order value outlook doesn't look that good compared to what estimates are at the moment. So of course that business is expanding. They're now offering flowers, they're offering alcohol, they're expanding into international markets. So definitely there has been a lot of growth. But what we're hearing from analysts is that a lot of this was already priced in. So expectations were very high, and you can imagine they were pricing for perfection. So anything less is a disappointment.
Denise Seikova, we thank you for keeping an eye on those markets. And for a closer look now at the markets, Catherine Rooney-Vera, StoneX Financial Chief Market Strategist, joins us now. Catherine, a lot of investors talking about the divergence you're seeing in the market today. How do you start to parse through the noise?
Well, your previous guest just said it, Shanali. I think that markets were priced for the perfect landing, and anything that deviates from that, even marginally, I think will cause disappointment. There's limited room for error coming into this year, and that's something that we at StoneX have been talking to our clients about. To hedge your bets, there are fat tail risks, and they can come from one of two opposing trajectories, and one of them is this robust economic growth, where you have, as Michelle Meyer correctly said, U.S. consumer has jobs. So yes, inflation is sticky. Service sector inflation is still high. People are paying for it, though, because they have jobs. So I think it's very difficult to envision a scenario where we have the U.S. economy growing at 1 full percentage point above potential. If last year the U.S. will have grown 2.8% and potential is 1.8, if were that to continue, inflation is very unlikely to move to trend 2%, which requires, of course, below 2%. So I think the markets are going to probably adjust if the economic variables come out, the economic data shows that we are not effectively entering a soft landing, which by definition is economic slowdown with a deceleration in inflation. At this point, we have inflation still kind of sticky, not at 2%, and we have economic growth remarkably robust.
How do you feel about certain sectors here? I'm looking at the Russell 2000. We have been waiting for that index to get its swagger back, and this week you saw it hard hit in the initial set of inflation data. You are still seeing a gain on the week. Do you feel good about small and mid caps?
Small and mid caps should do well if the Fed does reduce rates and if we see a benign economic environment. Anything apart from that, I think small caps can have a tough ride. For example, if the Fed is unable to cut the 100 or 200 basis points that have been priced in, then I think it's going to be a tough road. So look, I think if economic growth remains strong and 2024 is a repeat of 2023, which is immaculate disinflation and strong economic growth, then I think large caps do well this year. If not, if we get, the Fed that has to hold rates all year or, God forbid, hike rates, then I think all bets are off. And it all comes down to inflation. And once again, I agree with MasterCard. The fact is that the labor market is all important. And until we see some cracks therein, inflation can keep moving higher and people will still keep buying those goods and services.
Catherine, are there parts of the market that are looking a little bubble territory to you right now?
Well, yeah, I think the S&P 500 in general looks pretty stretched in terms of valuations if you look at history or if you look at international equities. So if we were to enter an economic deceleration, which is a soft landing, I think there's opportunities internationally. And in that respect, I would be looking outside of the U.S., even in Latin America or in Japan. But right now, I think that the U.S. is looking pretty frothy, especially if we consider the potential that there is some economic surprise surprises in the offing.
When you look at the whole week, you've really seen a ride higher in yields from the 2-year to the 10-year and even further out. How has that changed your thinking around discounting, knowing that perhaps rates will be a little higher for longer?
Oh, it's a great question because one of my biggest calls this year was the steepener, the 530s or the 730s, and that trade has been pushed out, so there's going to be better entry points. The trade we did get right, Shanali, was the put spread, the short put spreads on March futures contracts, and that worked out remarkably well. So we saw a more than 150% return on that when the markets were discounting the first Fed cut in March. We said that's very unlikely to occur. It's more likely in June, and that call has paid off very well. But I think when there's this consensus of equally weighted S&P and the 530 steepener, all of those things can be pushed further out if we get sticky inflation and we continue to see a Fed that's reluctant to cut.
How do you feel about mispriced opportunities? Is there anything that has been sold off in this market that you would pick up at this point in time?
Well, yeah, I think that the 2-year Treasury looks attractive at current yields. I think that if, in fact, we do get Fed cuts, which I do think are in the offing, that all those $6 trillion in money markets that are yielding, 5.3%, that money could move into short duration Treasuries. So I think there are opportunities. I still like hedging our bets. I still like put options. You can buy less than 4.5% put option that covers you at the money for the next 12 months. So there are opportunities in the market right now, and I would say that those opportunities come with hedging your risk exposure and buying those defensive sectors in a counter-cyclical portfolio policy that if things don't pan out as we came into this market anticipating, then they pay off nicely for a portfolio.
Talk more about those hedges. For the people who may get concerned about upcoming economic data or any other further sell-offs just due to valuation concerns, there's a whole host of things that could go wrong here, Catherine. Where do you look for cover?
Well, if you're an equities investor, I like certain sectors like staples and utilities, energy. These are kind of more defensive sectors. I like the put options, as I mentioned. I like gold and I like cash, and I think short duration Treasuries are a way to go in an environment where perhaps we get either a hard landing or we get a reacceleration inflation. And I have a 10% probability, Shanali, or I came into this year with a 10% probability that we continue to grow at a torrid pace. Reaccelerating inflation, the Fed has to not cut or even hike. But I think the possibility of that is growing. So I would look at inflation hedges, and I would also protect with more defensive sectors.
Gold and cash, safety trades still in vogue here. Catherine Rooney-Vera, thank you so much for your time. That is StoneX Financial Chief Market Strategist. Now, still ahead, we're going to take a look at the companies making the most buzz on social media today. Social climbers, that's next. Stick with us. This is Bloomberg. Time now for Social Climbers, a look at the stocks making waves on social media this morning. First up, Supermicro, riding a wave of AI euphoria. Shares of the AI hardware company have been on a tear this year, up over 250%. And Bank of America says the rally has even more room to run. The brokerage also noting that the market for AI servers will grow at an average rate of 50% over the next 3 years. The CEO joins Bloomberg Technology next hour. And next, we're looking at drug giant Eli Lilly, also seeing a relentless rally that has Morgan Stanley analysts wondering if it will be the first U.S. company outside the Magnificent Seven to reach a market value of $1 trillion. Finally, chip behemoth Applied Materials giving a bullish revenue forecast. The outlook suggests that the chip company is bouncing back more quickly than expected. China was a particular bright spot, with sales there accounting for nearly half its revenue. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Coming up, U.S. leaders are decrying the death of Alexei Navalny, the Russian activist who died in prison. We'll hear from Senator Ben Cardin, chairman of the Foreign Relations Committee, from the Munich Security Conference next. Stick with us. Important interview. This is Bloomberg. In honor of Black History Month, Bloomberg is taking a dive into combating racial biases in the banking industry. Joining us now is Kevin Cohey, One United Bank Chairman and CEO. One United is the largest Black-owned bank in the United States. Thank you for joining us, Kevin.
Thank you for having me.
It's been a very rough year in terms of inflation, higher interest rates for many banks. What has it been like to navigate this environment for your clients, particularly as the cost of financing has gone up?
Well, there's so much opportunity out here. Yes, we all want to talk about the risks that we're incurring, but for us, we see even bigger opportunities. Things like artificial intelligence offer unique chances at building substantial businesses that never existed before. So while I understand the concerns related to things in the economy, things like commercial real estate, things like loan demand, those types of things frankly come and go. And I saw this very interesting thing on your program where you guys talked about the richest people in the world getting richer as a result of artificial intelligence. So I think it's important that we focus on the opportunities that are ahead and not get bogged down by the risks that we face.
How do you focus on artificial intelligence in this era? Where does the capital come from and how are you deploying it?
Well, remember the theory is that you fortified your balance sheet to allow you to take advantages of opportunities. So it's not like you just woke up today and just started positioning your assets. So these types of risks have been thought about for years. And if you're running the company well, you've created the opportunity for the company to grow through all kinds of economic environments. That's certainly what we've done. We think about risks all the time, but we put our balance sheet into a position where we could take advantage of risk-on opportunities, but most importantly, to continue to build our business. How in this era of data aggregation, in this era of artificial intelligence, can you not take advantage of this? I mean, this is such a big shift. This is like going from steam to electricity, going from an agricultural-based economy to an industrial economy. So in the face of that, in the face of the opportunities that creates for wholesale change in the way products and services are being delivered, should you be caught up in what is the latest thing that the Fed did about interest rates or didn't do about interest rates? The Fed's going to do what the Fed does. It's wonderful that we have such an organization. Now, the good thing about our government is it spends tremendous amounts of time and energy mitigating risk.
So when we're thinking about AI in financial services, there have been a lot of questions about what it can or can't be used for. Where are you finding the most ability to make it the most useful for your clients?
It makes people more financially literate. The biggest problem that we face in our country is this issue of financial wellness. If you want to know what people are thinking about, they're thinking about, where am I going to get the money for this? How am I going to pay for that? All of these financial concerns. One of the things that leads to these financial concerns is our population isn't as financially literate as it should be. If you just think about it, we don't teach financial literacy. K through 12, we don't teach financial literacy. We teach all kinds of things that we rarely use, like the example I always use is, well, when's the last time you solved a chemistry problem? I don't know, maybe it's me, but I haven't solved a biology. It's been a while. Okay, it's been a while since I solved a biology problem. However, you solve financial problems all the time. And that's one of the big things at One United Bank. We're pushing for a national referendum to make it critical, not critical, but necessary to teach financial literacy K through 12. We think there's nothing we can do to improve our society more than that single thing.
It's interesting you mentioned that because even at the state and local level here in New York City, there's inklings of a greater conversation around just that idea. Mm-hmm. How much support do you think that could get? A national referendum is certainly on a much larger scale.
I believe we're going to get it because of the value we create. People realize we forgot to teach financial literacy. We just forgot. It skipped our minds. And as a result of that, think about the wealth creation opportunity just simply from young people, children starting to save and meeting their new best friend compound interest. Just the wealth that is just created by starting systematic savings, much less having an understanding of things like what is a stock? How do you think about a stock? How do you think about a bond? And how do you think about other financial opportunities? And as more of our society becomes more financially literate, we will all be better off financially, and there will be even greater opportunities.
Kevin, there's been a lot of conversation about how the number of black-owned banks in America have declined over a number of decades. What can the U.S. government be doing, the banking system at large be doing to support the system of black-owned banks in this country?
Well, I have to give them credit. They are doing a lot. The banking regulators are working overtime to try to create opportunities for black-owned financial institutions. So we went from an era of lip service to an era of activism, understanding the importance of having different kinds of providers for financial services. And I believe they not only understand it, but are taking action to create stronger black-owned banks throughout the United States.
Kevin, we thank you so very much for your time. That is Kevin Cohey of One United Bank on all the promises of the future. Now we're going to turn to events unfolding now on the global stage. This morning, Russian activist and vocal Putin critic Alexei Navalny died in prison. The news comes as world leaders gather for the Munich Security Conference in Germany. And joining us now is Democratic Senator from Maryland and Chair of the Senate Foreign Relations Committee, Ben Cardin, as well as Bloomberg's Anne-Marie Horton. Anne-Marie.
Yeah, Senator Cardin, thank you so much for joining Shonali and I. Given we've woken up to this news, we have heard from administrative officials saying that they are waiting on this confirmation. But what we do know from Russian news alerts is that Navalny has died. And the president years ago has said that there would be repercussions if Navalny was to die in prison. Is there anything this administration or you as the chair of the Senate Foreign Relations Committee can do in terms of penalties against Putin?
Well, this is a tragic event. Mr. Putin is fully responsible for Mr. Navalny's apparent death. It is absolutely tragic. The Vice President spoke here at the Munich Security Conference, Vice President Harris, and repeated that there will be consequences. Mr. Putin's actions are just against all humanity. Mr. Navalny was the principal spokesperson for the opposition to Mr. Putin, and Mr. Putin decided that he had to be taken out, and that's outrageous.
Is there any actions that you intend to take from where you're standing, Senator, in terms of any future investigation or anything?
There's many options. There's many options that we can take a look at. As you know, we've already are engaged in action because of Mr. Putin's invasion of Ukraine. So that we've already taken sanctions activities against Russia. But there are other, we're going to speak out about this. We're going to look for other ways that we can hold Mr. Putin accountable for these actions. And we'll work with the Biden administration and the international community to make it clear that this is outrageous. It violates all basic rights, and Mr. Navalny will not be silenced. His cause will live on, and we're all going to fight for the Russian people that Mr. Putin now has a grip on.
Well, your committee has already backed the United States going after Russian assets, freezing them, taking that money, and making sure they can give the windfall from that money to Ukraine. Where are we in that? Your committee has backed the administration from doing it, but so far, nothing has happened.
Right. Well, the assets are frozen. Now, whether we'll seize them, we passed legislation that would allow the government, the U.S. government, to seize those assets and use them to compensate Ukraine for the damages. The United States holds a small fraction of Russia's international assets. Most are held in Europe. So we need to work with our European partners if it's going to really mean something in helping Ukraine from the point of view of the financial compensation. So at the end of this war, Mr. Putin needs to be held accountable for his war crimes, and Russia needs to be held accountable for compensating Ukraine for the damage it's caused. And we believe the assets that we have control over can help deal with that.
Well, you're in Munich now. What are your European counterparts telling you about whether or not they'd sign up for this?
We're having conversations here in Munich at the security conference. That's one of the areas that I've been talking to the Europeans about. I think we all agree that Russia needs to be held accountable. The legislation is very clear. If Russia joins an international effort to compensate Ukraine for the damage that's done, that's one thing. But if they don't, then we need to look for every avenue we can to help the Ukrainian people, including seizing and using Russian assets.
Senator, do you think the death of Alexei Navalny is going to put fresh pressure on the House of Representatives to pass the foreign aid bill that you and some of your colleagues in the Senate said yes to?
The House of Representatives must pass this bill. The aid to Ukraine is desperate. We passed it by an overwhelming bipartisan margin in the United States Senate. We know that their votes are in the House to pass Ukraine aid. Now it's up to the Speaker to bring that bill to the floor. This death of Mr. Navalny is just another reason why we cannot let Mr. Putin win the war in Ukraine. We can't let him export this type of aggression to other countries beyond Ukraine. So yes, it's another reason why it's urgent for the House of Representatives to pass the aid.
I mean, Senator Cardin, on that note as well, does the death of Alexei Navalny change the conversation you're having with your Republican counterparts about passing more foreign aid?
Well, we have a tough budget. We recognize that. The United States is engaged globally on so many different issues. I'm here with the members of the Appropriations Committee that have that responsibility. I think you're going to find that we will continue and expand our assistance to other countries to fight tyranny, to support democracy. So yes, I do hope that we will be even more aggressive in the financial ability to act on behalf of democratic states.
Senator, there's been a lot of sanctions and penalties levied at President Putin and the Russian economy. But given what we've seen in terms of Putin not backing down in Ukraine, we have the latest instance this morning of what the vice president called brutality with the death of Alexei Navalny. Is it high time that the administration sanctions Russian oil and gas? Because you and I both know that is how Putin is able to fund this war.
Well, we do have sanctions on the energy sector, so there are sanctions. The question is, how do we enforce those sanctions? And we need to look at secondary sanctions beyond just a Russian entity, but other countries that are avoiding the sanction regime to be able to take action against their companies that are violating the restriction we have on Russian energies. So yes, we can enforce the sanctions more aggressively, and Congress may need to provide additional authorities in order for that to be done.
Well, we do see Europe doing that. They're going after secondary sanctions. They're going after some companies in China. Would the U.S. be willing to go after Chinese companies that you think are moving around the current sanctions on Russia?
We have legislation pending before the Senate Foreign Relations Committee that does exactly that. It's under active consideration, and we're in negotiations right now as to what we can do to enforce sanctions against Russia, including looking at Chinese companies that are violating those sanction regimes.
Senator Cardin, we're talking about the relationship to Russia at large, but what about the current events here? Will Senate open an investigation to Alexei Navalny's death abroad?
We're going to be looking at with the administration as to the circumstances surrounding his, we believe, death. His spouse is here in Munich. I had a chance to talk to her briefly. She asked for accountability. There's going to be accountability. So we'll work with the Biden administration to make sure we get all the facts the best that we can and be able to sort out what our options are.
Senator, just finally, I was struck by what the vice president had to say about isolationism and denouncing isolation, something that you know we've heard a lot from the former President Donald Trump, who's talked about NATO and the delinquencies of some NATO countries. Today in the Financial Times, Ursula von der Leyen is talking about subsidizing the European Union, some of these corporations in the defense contracting space, so they can hit their 2% target, so that there's more defense spending in Europe. Would you be in support of that? Should Europe be doing more within the EU market to subsidize their defense space?
I'm not sure I completely understand your question. I might have lost a little bit at it. But we are very engaged globally. We're going to continue to be engaged globally. I'm asked a question frequently about the United States engaged with our global partners. We are going to stay engaged. It's in our interest. We're fighting to preserve democratic institutions, and we're going to do everything we can to make sure that's a reality. Look, there'll be some challenges along the way. We have some challenges with some of our allies. The bottom line is the United States is going to be the global leader to protect democratic institutions.
Senator Ben Cardin, we thank you for your time. Now, coming up, we're going to go back to the markets. We're going to talk about the ETF industry. Stick with us. That'll come up next. This is Bloomberg. Time now for Wall Street Week Daily. Host David Weston sat down with Richard Haas, the President Emeritus at the Council on the Foreign Relations. Take a listen.
I actually think Joe Biden's done a pretty good job on foreign policy. I might have one or two areas I disagree. But whatever you think about it, I don't think voters are going to have that foremost in their minds. It might be questions of his age or Mr. Trump's legal issues, maybe questions of the border or inflation, you name it. What's so interesting, David, though, is even though most voters won't vote on the basis of foreign policy, whoever's elected, given what you said in the lead-in, their differences, this election will have enormous consequences for the world and for America's relationship with the world.
Yeah, one of the things that strikes me, George W. Bush did not run on foreign policy issues, and yet he ended up being a foreign policy president, whether he wanted to or not. So give us a sense of some of the differences, you think, on some of the key issues. You've got war in Ukraine continuing, you've got Middle East, you've got climate, you've got China. What are some of the differences between these two people?
Well, actually, China's one of the areas the differences might not be that great. They're both pretty tough on China economically, not so clear about geopolitically. Mr. Biden is tough, not clear about Donald Trump. On trade, neither one of them is much of an enthusiast for trade, as you've noticed. Both wanted to get out of Afghanistan, but that probably ends most of the similarities. Ukraine, obviously. Fundamental differences. Joe Biden has really made that the centerpiece of his foreign policy. More broadly, the centerpiece of his foreign policy is allies. It's an ally-first approach. He sees allies as giving us a real comparative advantage, a way of leveraging leveraging American power. Donald Trump sees allies as an albatross, as free riders. He doesn't much care about them, doesn't much care about Ukraine's fate. That's probably the biggest single difference. Climate change, though, is also fundamental. Last time Mr. Trump was in, he took the United States out of the so-called Paris process. Joe Biden did the IRA, very much wants America to more than pull its weight in the climate area. Middle East is more complicated. Not clear that either would have a whole lot of influence over this Israeli government. Mr. Biden may try to have more influence. Not clear, though, that it's leading to much. When Mr. Trump was president, he wasn't much interested in the Palestinian issue. Joe Biden, however, is. Big difference there. Iran, neither one is quite sure what to do. Iran is getting closer to nuclear weapons capability. Donald Trump, some would argue, helped pave the way to that by pulling the United States out of the nuclear agreement. Joe Biden wanted to get the United States back in. It didn't work. Either way, who's ever elected, he's going to have to deal with an Iran that's probably on the so-called threshold of a nuclear agreement. Plus, you make a really good point more broadly. You don't know what's going to happen. 9/11 wasn't in the works. What happened in Gaza on October 7th wasn't something we planned for. For all we know, the next president will have to deal with a crisis in Pakistan, which is politically unstable and, as you know, has dozens of nuclear weapons. Or maybe it'll be North Korea doing something, or maybe it'll be something in the Americas. At some point, we end up voting for these people less because of their policy papers and more because of their judgment and who they're likely to bring into government with them.
So we tend to think of it as what's at stake for the United States in the election of president. I wonder what's at stake potentially for Europe in this election, because you mentioned Ukraine, NATO. Just this week, this has been in the news, given what former President Trump had to say about inviting President Putin to invade a country if he wanted, but also on the trade front. President Trump, when he was president, was not particularly friendly to Europe. What's at stake for Europe and the pressures that we put on Europe if, in fact, Donald Trump pursues the things he says he may?
Big differences, and I think one of the reasons Europe is now so focused, almost obsessed with our politics. Donald Trump represents potentially a fundamental departure. NATO, American commitment to Europe, has really been the mainstay of our relationship with the world for, 3/4 of a century. It is not clear that Donald Trump values that. Not clear that he would continue to support it. And he doesn't have to pull the United States out of NATO formally in order to essentially undermine the value of the commitment. If Joe Biden's elected, you know it's going to pretty much continue. But I think a fundamental question mark over America's commitment, not just to Ukraine, but to Europe across the board. Indeed, one of the things going on in Europe now, David, is how do they prepare for this possibility, either if Trump were elected, or even if he's not, if Congress begins to get in the way of, like they are in the case of Ukraine. The really interesting conversations are taking place in Europe about how they become either less dependent on the United States, more self-reliant, or some combination of the two.
I also wonder about the divisions, domestic divisions. Just this week, we've seen the fight in the Congress about aid to Ukraine. I've always understood that historically, basically partisan politics ended at the water's edge. We did not export to our foreign policy. That seems to be gone. What does that say about the role of either Joe Biden or Donald Trump as the president going forward, in the sense that Congress won't be supporting them?
I wish I could disagree with you, but I can't. I don't mind having healthy foreign policy differences. We did over Vietnam, over other issues, but this isn't that. What we're now seeing is people don't want to go along on a foreign policy issue, not because of the merits of the policy. They don't want to go along because they fear or they oppose the domestic political repercussions. That's a clear violation that politics stop at the water's edge. This is something qualitatively different. It's bad now in the case of Ukraine, Taiwan, Israel, but it presages something really bad for the future. It basically says foreign policy is not so special. We're not really respecting it or taking it seriously, despite the stakes, despite its impact on the world, despite its impact on us. That's something very different. I don't think you would have seen that during the Cold War, but what we see now is a different mentality. The foreign policy is no longer that important. Obviously, particularly on the right, the MAGA right, much less on the Democratic left, but we're also seeing it there. There's a real resurgence of isolationism.
That was Wall Street Week host David Weston with Richard Haas of CFR. Now, the 2024 Exchange Conference concluded in Miami this week, and for a recap of the week's events, we are joined by Emily Graffeo. What were the big themes? We were talking so much about some of the giants. State Street is in the news for a few reasons today.
Yeah, well, so the ETF Exchange Conference is pretty much the ETF industry's largest gathering. There's over 1,000 financial advisors, ETF market makers, traders, of course, the fund issuers, they all gather in Miami. And I noticed one really big theme was model portfolios. Down at the conference, Katie Greifeld and I sat down with Pete Hill. He leads model portfolios at State Street, and they actually have a kind of smaller slice of the model portfolio pie right now, only about $5 billion. You compare that to BlackRock, which has about $100 billion in their model portfolio business. And so a lot of the conversations were around how do ETF businesses kind of scale this part of the industry. More and more financial advisors are asking for model portfolios, a ready-made strategy of a number of index ETFs kind of all packaged together that State Street or BlackRock can just offer their clients. And so we talked with State Street about their plans to hire about 10 employees and scale their business to about $25 billion in assets over the next few years.
We only have a minute left here, but options have obviously been a very hot market these days. You've seen a lot of different types of companies capitalize on them. What are the options overlay strategies that people are talking about?
Everyone was talking about income still, which feels like that's been a theme for a while, but JP Morgan's JEPI is one fund that comes to mind. Saw a ton of advertisements for that fund down at the conference, but everyone was talking about launching a new fund that had some sort of options overlay strategy where the investor can get equity upside, but also protection from an options overlay type of strategy.
Our thanks to Bloomberg's Emily Graffeo for being all over it this week. And tune into ETF IQ on Wednesday next week at 12 p.m. Eastern. Coming up, DraftKings CEO Jason Robbins joins Bloomberg Technology with Caroline Hyde and Ed Ludlow. That's up next. This is Bloomberg.
heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up in the next hour, unpacking those earnings. DoorDash delivering the goods, but while the stock pulls back, while DraftKings is betting big on the lottery. Conversations with both companies this hour.
Plus, Supermicro drops, ending a sizzling rally that put the server company on a record-breaking week. We have an exclusive conversation with the company's CEO coming up.
And OpenAI CEO Sam Altman is looking to get the green light from the US government to raise billions for a massive venture to boost global manufacturing of those AI chips. We'll bring you the story. But first, check in on these markets. And look, we are running too hot when it comes to producer prices. The inflationary push is once again there, and it has its effect on stocks, particularly in the tech sector. We're off by 0.5% on the Nasdaq. The S&P 500 pulling back on what has been a run of weekly gains. We're currently off by 0.2%, but still clinging to that $5,000 mark. We're looking at a two-year yield that reacts to the inflationary pressure. Bonds across the board selling off, yields go higher. We're up by 9 basis points. Moving on to what's happening in the world of the risk asset of choice that we like to call it, Ed, Bitcoin. And actually notable that it stays higher, even though the US dollar rises on the back of the inflationary push from PPI. We're actually seeing Bitcoin now up to 51,800 sort of mark, almost getting on that 52,000 handle. And it's been a running up of a week. We're out a percentage point on that. But Ed, what are you watching on the micro?
Well, there are almost too many company reports to go through, but to the upside, Coinbase, we got exactly what we thought we might. A profit and the EPS level. There's a lot of close correlation with recent performance in cryptocurrency and what's happening in Coinbase, and it is one of the movers to the upside. Roku, completely different story. In the streaming context, it actually did quite well, but the street's micro-focused on revenue per user. The stock down 20%. We'll try and dig into it more later in the program. Supermicro, as we said, later in the show, the CEO is coming on. They're actually now not on track for another record week in terms of the stock's performance. Last week was a record week, but it's just been crazy with the stock rising to above $1,000 a share. What is it that they actually do? That's the basic question. And then I flagged Microsoft because of that report that I put out with my colleagues about Sam Altman basically saying to investors, I can't raise money for this chips venture unless I get the blessing of the US government. Then there's the here and now with DoorDash. I find DoorDash really interesting because it has performed really well. The technology story in the quarter was new product lines, doing more stuff on the platform, but it was a high bar quarter. So when you look at their guidance for the full year in terms of gross bookings or orders, it seems strong, but clearly the stock is down 10%. So what is it that the street's not liking? It's hard to tell.
And perhaps it's that EBITDA guidance, not surpassing it for once. We're staying with DoorDash. Let's dig in with the CFO, Ravi Inukonda, joining us for those fourth quarter numbers. And I start with, well, the tough one, Ravi. The takeaway is not quite good enough. Can you talk us through perhaps the adjusted EBITDA number, the concerns creeping in, or is it just that your stocks performed too well of late?
2023 was truly a transformative year for us. It was an inflection year for us, both from a growth as well as a profitability perspective. We've truly become a daily habit. More users